Hello, everyone, and welcome to Piponomics YouTube channel, where we will trade live together and teach you the fundamentals of trading. Today, we are here to talk about the butterfly harmonic pattern. And the harmonic pattern, or any harmonic pattern, is a corrective move the market makes before the continuation of the trend. But how do you decide where that continuation will begin, right? Well, that's always at the D point. So the first thing you do when you get your harmonic pattern is you want to locate that X point. And a lot of people might think, oh, X point is the end of the trend. But actually, the X point is the beginning of the trend, right? Beginning. And then the A point is actually the end of the trend. Oh, so confusing, I know. But once you get it and you know it, it's now part of your mental Rolodex, right? So the A point actually represents the end of the trend. Okay. And then you have your B point. Your B point is actually your first pullback. B point is your first pullback. And your C point is your pullback of your pullback, not breaking point A, or will no longer be a butterfly harmonic pattern, but is the pullback of the pullback, right? And then point D finally is the continuation of the trend. Point D is the continuation of the trend. Okay. And when you look at this, you're like, wow, how would I have known that? What I like to do is I actually like to program my indicators onto my chart so that I don't have to measure. But if you do want to measure, you take your Fibonacci tool and you measure one from X to A, and you can identify your support and resistance, with resistance being on top and support being on the bottom. So 100% to your 0%. And then you can measure your C point to your D point. It should be the same length. Okay. And then you can program even in your stop loss. And that's something you want to add to your Fibonacci tool is your stop loss, which is always going to be 1.15%. So 1.15%. And you want to program that in because that's a good stop loss. So if price comes down, hits that stop loss, I know that, hey, I managed my risk. I'm not in it to lose it, right? Whatever I've gained already. And I'm protecting my account. So you always want to have a stop loss, especially as a beginner or even as an advanced. You always want to have something because there's something that can always go on in the market. War can break out and boom, your whole account gets, taken away because you're in that trade for the opposite direction. So you want to always protect your account, protect your money, and because a lot of us do this as a livelihood. And to get to that point, you want to be able to be defensive. So continuing on, I'm now no longer in need of my Fibonacci tool because I measure where that D point might have happened, which is between the 50% and the 618%, right? That is where it occurred. And then it went back up to retest my 0%, And if you're looking at this at a how do you know? Well, once that next hump happens, you're going to measure, you're going to take this Fibonacci, you're going to move it over to the next hump, and then you're going to be able to say, hey, this is the 0% because it went and it retested between the not breaking a high of A, but it came just a little bit lower than that first hump, making an M shape, which also signifies a sell-off. Okay. And this is the market's way of tricking you because a lot of us are looking for M's and W's, and we're going to go more into detail in another module about that. But that's the way of the market tricking you. But what they also have in their arsenal is that D point that say, hey, this is an area where the market just may turn and go the opposite direction. And you have it marked off here of your 0%, letting us know that, hey, this is support. Now it's resistance because your candlesticks are below it. And then how do you know to get in here, or how do you know to stay in here? Well, one, if you hit market execution, you will still be in this trade. And two, you want to look into the future by using your parallel channel. And all you're going to do is you're going to block in that D point up to that A point. And you're going to say, hey, these are now another level of support and resistance, which is your trend lines. They're just now diagonal. Okay, so here you have also support or resistance because your candlesticks are on the bottom of it. But once it comes back in, and if it comes back in, you will have another area where you will say, hey, the market tends to retest the key area 3 to 5 times before it breaks through. 3 to 5 times before the market breaks through. So here you have another level of support and resistance. We're going to put resistance at the top. And right now, yes, right now, we do, instead of it being a support down here, it's more of a resistance area. But this is technically your support, and you want to see price come back in there and stay in. Now, this just might be a way of the market, playing with you because you really don't know which direction it wants to go, because it's between your stop loss that you marked at your 1.15%. And you have like a bunch of stuff going on, right? But this is all areas of the fence. Now you know what you can watch for, what price does at these areas. You also have your 50%. Your 50% line is very important because price can go up to 50 and then decide that it doesn't want to go any further and break down and come back down. And then you obviously don't want to see it break out and stay out. But your stop loss is still down here. You want to consider taking profits at these areas. So if price does break above your 50%, you want to start moving in your break even. You want to start trailing your profit. And then you have these different points of interest in which price will go retest and decides if it wants to continue to go up or come back down. So we are in an uptrend. We can see they're right pointing upward, which is another way to kind of keep to keep current of what it's currently doing. I also want to point out when price breaks out, right, which it did, it might want to retest, and if it doesn't come back into our array and decides to come back down, we're now out of that trade. Because one, it hits our stop loss, but then two, it's telling us that, hey, this it just threw a harmonic pattern in there to confuse most of us, but it's the actual direction is down. We are grateful that we have a stop loss at that point because we've managed our risk and we've protected our account. So never go in blindly. Always know where price can pivot, and that's what I'm showing you on the board now. So hopefully you learned something, and I see you in the next module. Bye.